itself. The borrower wants to purchase an item, but doesn't have the funds to do so at the present time. However, the borrower does have confidence in having sufficient funds over time to pay both the original price of the item and the interest on a loan. So he goes to a bank to arrange a loan. The borrower is capable of making a credible promise of money in the future, but otherwise at this moment he comes with empty pockets. That's why he needs the loan. We're probably all familiar with what happens next. The bank gets the borrower to sign an agreement in which the borrower promises to pay the bank the amount of the loan plus interest, or, in default, surrender to the bank the object that is to be purchased with the loan. This is done countless times every day all over the world. But there's a problem. How can the borrower pledge as collateral something that the borrower does not yet own? If I wanted to borrow $10,000 from you to go on a luxury cruise to Europe, would you accept my neighbor's car as collateral? Of course not, because you know very well that I have no legal right to give you my neighbor's car, no matter how much I owe you. But if instead I promise to buy my neighbor's car with the $10,000 you lend me, the situation is different. You might agree to lend me the $10,000, believing I will buy the car, and will pledge it as collateral for the loan once I obtain legal title to it. However, until the transaction is completed, your $10,000 loan cannot be secured by title to the car. This sequence of events problem could be very simply avoided. You could buy the car and then sell it to me. The bank could do it this way too. If the borrower commits to the bank to buy the item, why doesn't the bank just buy it with its own money and then sell it to the borrower on time payments at interest? Well, the answer to that question is also very simple. It's because the bank, like the borrower, has come to the transaction with empty pockets. The bank fulfills its part of the so-called loan transaction by creating an account for the borrower. The truth is, the so-called borrower has funded his own account by fraudulently pledging a car he does not yet own as collateral. And the bank, the so-called lender, hasn't put up any existing money at all. And, if all goes well, it never will. The borrower believes the new numbers in his account now represent his money in the bank. He, like the rest of us, doesn't understand the difference between existing money and a promise of money. If he can spend it, what does it matter? So now the question is, will the seller of the item accept the bank's promise to pay? While some people may hold out for cash, most will say yes to a check or an electronic funds transfer from the buyer's bank. Why? Because the seller knows from experience that she can deposit the check at her bank and it will increase her account accordingly. So what happens next? Well, obviously the buyer's bank now owes the seller's bank the amount of the loan. So you might be thinking, isn't this where the money comes out of deposits? The bank's promise to pay the borrower has just been transformed by the transaction into a promise to pay the seller's bank instead. So now the buyer's bank has to transfer some of its existing money to the seller's bank, correct? Yes, but probably only a small proportion. And over the long term, as long as the bank gets its fair share of deposits, the net amount of existing money the bank needs to cover its loans can theoretically be zero. How? Well, imagine first that the seller has her account at the same bank as the buyer. She deposits the buyer's check into her account. All the bank has to do to complete the transaction is reduce the buyer's account by the same amount it increases the seller's account. As both accounts are just promises, no existing money is involved in doing this. What is the end result? The bank has created bank credit for the borrower to the sum of $10,000. The borrower has bought the car that existed in the world of real things, and the seller now has that bank credit of $10,000. Thus, a brand new claim upon $10,000 worth of real goods of value was accomplished with absolutely $0 of the bank's or anybody else's money. On top of that, the bank gets to have all this so-called money paid back by the borrower's honest toil, plus interest, or the bank gets the car. Magic like this is usually seen on stage. So now let's examine what happens if the seller deposits her check in a different bank. Won't that require a transfer of existing bank funds from the buyer's bank to the seller's bank? Perhaps, but it will almost certainly never be anywhere near the whole amount because, in effect, the banking system functions as one bank. To illustrate, let's add another transaction to this scenario. That same day, the seller's bank made a similar loan to a little old lady who bought a mega home theater system. The electronics store deposited her check at their bank. The electronics store's bank made a similar loan that was deposited at the original borrower's bank. And when all the various balances were settled, the banks didn't owe each other anything. And even if there were differences, they would have been just a small portion of the total credit created. So, at this point we can say that although banks don't actually lend out their depositors' money, as most of us imagine, they still need deposits to make loans. This is because banks need incoming credit from other banks to offset their own credit being deposited at those banks. As long as banks keep their outgoing credit balanced with incoming credit, they are free to make new loans and thereby keep creating brand new credit money. None of it will ever have to come out of the bank's pockets. The bank is free to invest its own funds in corporate and government bonds and whatever other instruments their charter allows. If one draws a diagram of it all, it looks like this. The interest governments and corporations pay the banks on their bonds is paid by us. We pay it as a portion of our taxes, and we pay it in the price of all the goods and services that we buy. And there is another thing passed on to us as well, and that's the risk that the bank will go broke and not be able to honor its promises to pay. Now you may wonder, how can a bank go broke if it doesn't put any money up in the first place? What have they got to lose? The answer to that question is that banks differ from counterfeiters in that the banks are legally allowed to create new money, but only by certain rules of accounting. Banks can only create money by entering a borrower's payments and collateral as an asset on the positive side of the ledger, balanced on the negative side by the loan, or what the banks call the deposit liability created by the bank. When the borrower defaults on the payments, the asset pledged as collateral is seized by the bank and sold. In a declining market, when repossession is most common, the new lower value of the asset doesn't cover the bank's liabilities, which were based on the previous higher value. This shows up as a loss on the bank's books. When foreclosures are rampant, as in a collapsing real estate market, much of the value of the bank's collateral simply evaporates as home prices drop, exposing the bank to huge losses. In truth, it's all just numbers, created out of thin air. But banks must adhere to the dictates of these numbers, and the consequences of bank arithmetic gone wrong can include economic standstill, social disintegration, total financial chaos, lawlessness, starvation, and war. However, for the purposes of understanding the anatomy of a loan, we shall assume that the system is still functional and all three of the loans we were looking at will get paid. The end result is that not $1 of existing money has changed hands,